Welcome back to the Clifford Chance Australia Private Capital Podcast, where today you'll hear part 2 of our engaging conversation with Dr. Mike Caristo, Principal of Genesis Capital Private Equity. I mean, there must have been some challenges starting a private equity firm from scratch. Were there any that you look back on and think that was a real obstacle for us or a key challenge that we overcame early doors?
Yeah. One of the things I didn't really think it through at the time, and maybe I should have, but there have been very few, I think before Genesis, I can't think of too many private equity firms that were founded in the way that we founded the Genesis, going the hard way, raising money deal by deal, building up enough of a track record, scraping together enough of an investor base that we can then raise a fund, versus other new private equity firms that might spin out as partners from an existing private equity firm and have 50 million of their own money to start off. And I think we underestimated how difficult that would be. Convincing investors who have worked very hard and taken risks to build their own capital to part with it and entrust it to you it was absolutely difficult. And so we did a few things to get through that obstacle. In the early days, we had a strategy consulting, M&A advisory, and a private equity business. So we were three businesses in one, so that we could continue to pay our mortgages and convince our wives to give us a little bit more rope to get the business off the ground. And that was difficult, making sure that we could balance all those priorities. It was another thing that we found difficult was building the team. It's a little bit chicken and egg. You want to have the economics to be able to fund the team, and private equity, once you've raised the funds, has a very stable set of economics. But before that, it's a little bit feast or famine. And so we had to convince our team to come along the journey with us and believe that we would make it to raising committed capital. And as a result, we have hangovers from those days in our culture still today. Everyone at Genesis knows what everybody else is paid. We publish the pay scales for the entire team every year, and it's not through some altruistic, new age culture. It was simply because we had a little mutiny in the early days and had to kind of show everybody our P&L and how much there was to go around, so that everyone kind of came along the journey with us. But today, it's we've had remarkably low turnover. Almost nobody has left the business from those early days. And the culture still today is one of a group of us all together building something that we've had the vision for a long time, as opposed to simply a transactional relationship where we're paying them for their time.
When I think of private equity, to be honest, I don't think about that level of transparency. That's not the first thought that I have. Would you say that's relatively unique to your organization?
Actually, we had in our most recent fundraising, we had some investors shocked that was how we did things, and said that they'd never seen that anywhere else. And as I said, it's simply a quirk of our history that we ended up that way. But it's stuck with us, and it really does work for us.
And were there any good luck moments that help you to reach exit velocity, or was it just sort of one step after another?
There was absolutely a lot of luck along the way. If I think back to those early days, deal by deal investing, we made 4 deal by deal investments, and we've subsequently exited 3 of those. But those 3 that we've exited were fantastic investments by any metric. But there was a heavy dose of luck in each of them. We bought a CRO and a bioanalytical lab in 2018 that represented our first 2 investments. I think we did a fantastic job buying these businesses in partnership with scientists. We didn't own 100% of them. We partnered with the scientist founders. We saw an opportunity in the market for Australia to benefit from the wave of clinical trials coming to the country. And I flew to, these were Adelaide-based businesses. I flew to Adelaide each week for over a year to really turn those businesses around. But the bit where we got incredibly lucky was 3 years later in 2021. There was a global pandemic, and biotech funding was at once-in-a-generation levels. And so if you owned a business in the pharma services sector, they were trading at multiples that had never been seen before, and I'm not sure that we'll see again. And so we exited at that time, and were really fortunate with the result we got for our investors.
And having an early success like that, or early successes like that, build a track record that then attract LPs.
Yeah, it happened really organically. That very first investment was with a very limited set of investors, which then by our second one grew a little more, which grew a little more by our third and our fourth. So that when we raised our first fund, something that probably makes it a little bit unique, we raised that first fund in 2021. And again, most, if not all, private equity firms in Australia are largely institutionally led, raising money from both domestic and offshore institutions. We did it the hard way. We had 250 individual LPs, almost all of which were domestic high net worths, 75 to 80% domestic high net worths. And we raised those directly, not via intermediaries, knocking on doors. And actually, because of those early successes, luckily there was a lot of word of mouth that helped us raise that first fund in the early days.
Wow, that's amazing. That sounds like a lot of work.
It was. But we were building a business.
And you've described the unique culture that your firm has, and you've got a very specific investment mandate. But are there any firms either in Australia or around the world that you look at and say, we'd love Genesis Capital to be that? For example, I know that we've spoken previously about Alpine Investors as a firm that you admire. Is there anything particularly about them that you think of?
Yeah, actually, so Alpine is a business I've come across more recently, and have gone, oh wow, there's a lot of parallels between what they've gone and built and what we're trying to build. I think the bits of what they do that I really resonate with. The first is, I think most private equity firms, certainly in Australia, have, as they've gotten more and more successful, they've increased their fund size, one fund after another, and grown to a different market to the one that they originally started out with and where they were most successful. Certainly, that's what happened to my previous firm at Crescent. They've grown to be really large now. Alpine have said, no, we are squarely low mid-market investors. We love businesses that are making 20, 30, 40 million of revenue, buying off founders who are having succession issues, and we back ourselves to add value to those businesses. So that's the first thing that I really resonate with. And I think if we're being true to our investment philosophy, being a healthcare specialist in Australia works if you stay in that mid-market and don't grow too large.
So resisting the challenge of chasing AUM and staying to the core of what's made you what you are.
Well, interestingly, Alpine has managed to get grow their funds under management, but they've done so horizontally. They've said, well, that's the thing that we're really, really good at. The other thing that they're really good at, which I believe Genesis is also good, but I'd love for us to be even better at, is how they add value to businesses. So that sort of business that is transitioning from a founder requires some really active involvement. And yes, you can get them at really good prices, but you need to really know how to transition it safely and then grow it. And so they've got a really innovative way to make sure they're bringing in the best talent, and they're not afraid to roll up their sleeves. As a result, they've said, well, let's make that core skill set scalable. So they've sponsored additional funds vertically and increased their kind of velocity of capital, raised more funds more frequently, but stayed in that each fund and their core underlying investments have stayed in that mid-market zone.
To scale a business like that, you'd have to have a lot of discipline, I think, about who you bring into your business because you couldn't do it all yourself. And you'd be finding that now, I'm sure, in your own business. Are there particular traits or qualities that you look for in people when you're advertising?
Absolutely. The first thing is we've been really lucky. As I've said, some of that early team from 2018, 2019, in fact, almost all of them are still with us today. And they've grown and gotten a lot more experienced alongside us. And so some of that natural scalability has occurred as folk, we've got our third investment managing director now, Ashton Tay, alongside us, who've learned how Genesis invests alongside us. We've learned at the same time they have. And so there's an inherent scalability there. But as we look for more junior folk to join us, we are looking for the same things. I think we are we tend to believe that we can train new people in the kind of hard skills, how to build a model, how to read a balance sheet, how a particular healthcare industry works. But the bits that we find hard to train are kind of some of the attitude and mindset skills. You want someone that's got a little bit of hunger, really wants to make an impact, and someone that's not too precious to roll up their sleeves. Investing in these smaller businesses is often not glamorous, and everyone up and down the scale at Genesis sometimes needs to roll up their sleeves and get stuck in. So that attitude is also really valued, and also having a commercial curiosity. There are some people that really lend themselves to curiosity about a business, how it works, curiosity about a market, how it works, and is drawn to that more than they're drawn to the anatomy of a deal and a transaction. I think that's what we really look for.
Yeah. Maybe that mindset of what do I get to do today rather than, I've got to do this today.
Absolutely.
Yeah. Your Genesis's position in the market has moved a lot. Your profile is much higher than it was. Has that tangibly changed life for the firm?
Yes and no. I mean,
like fundraising, for example.
Yeah. So look, absolutely. So on some of that, it really has changed. So we had investors in our last fundraising round say, it's great to see new firms coming up, and it's been eight years of long work to kind of really pop up onto the radar. Similar with some advisors as well as some vendors. So they'll say, I'm now thinking of you guys when it comes to healthcare businesses. I think particularly when we talk to vendors or founders of healthcare businesses, it's really helpful to be able to point to some historical successes. That's definitely changed the nature of the conversation. Also on the employee side, it would have changed. We've got employees now. We've got people in the market now approaching us about employment opportunities within Genesis, which is a nice change. But at the same time, we're still pretty focused on the core attributes that made us that took us to this position, and actually day to day in the firm. It hasn't changed as much as it might sound. We're still very focused on those mid-market deals, on rolling up our sleeves and adding value in the businesses, and doing what has been so successful in getting us to where we are today.
And could you just touch briefly upon how you source those mid-market deals? Are they through processes? Are they proprietary opportunities, or a mix of both?
Yeah. Actually, this is a statistic we share during our fundraising. 90% of the investments that Genesis has made since its inception have been completely proprietary, and so outside of market processes. Broadly, businesses find their way to us one of three ways. The first is, yes, absolutely, intermediated deals from advisors. We will always make sure we take a look. We think one of our goals is to be across hopefully almost every healthcare transaction within Australia and New Zealand. And so we do want to make sure we stay across advisor-led deals, but it only represents 10%. We very often find that even if we participate in a process, our value add, what helps us win is not paying the highest price for a business at auction. The other two ways they find their way to us are inbound. So increasingly, as time has gone on, as we've built a reputation, either directly from vendors who will knock on our door, send us an email, or approach us often through an intermediary and ask for an introduction to us. They'll say, "We saw what you did with Business X. We'd love to chat to you about our business." And about 30% of our investments come about that way. The rest, the other 60%, are outbound driven. So we have a dedicated outbound function. It's led by James Hamlin, our MD of origination. And we go about that thematically. We go, what sectors within healthcare do we think are not just attractive now, but will be attractive in 3 or 4 years from now, just like the pharma services businesses we invested in first up. Let's map the universe of all of the businesses within that subsector that we can find. Let's meet as many of them as we can and reach out to them. And then once we find it's a multi-month process, we've really seeped in an industry, understand how it works, who's who in the zoo, who's reputationally strong, who's not, and then often we get to pick which partners we can work with in that subsector.
You've touched upon some of the early successes and a bit of good luck, and you've maximised the return on that good luck. Are there any other transactions that are particularly memorable for you in the life of Genesis Capital so far?
Yeah. Maybe it's because you're sitting across from me, David, but the Pacific Smiles transaction that we worked on together is one that I think is particularly memorable.
Yeah.
It was an interesting transaction. I think firstly because while we knew dental really well, as I'd mentioned already, we'd invested in dental a couple of times before looking at Pacific Smiles. It'd been a business we'd been watching for a really long time, and so outside in, we built a lot of conviction that it was a great business that had temporarily lost its way and that we could help to restore to its former glory. But in a lot of ways, that was the easy bit. Then there was a whole host of other things that we needed to do to make the investment that I had very little experience in and was learning for the first time. The first thing we had to address was, well, it's a publicly listed business, and so it's being marked to market every day, and it's supposed to be an efficient market. How can we have such conviction that it's a great investment, but the rest of the market not see it the same way? And so we spent a lot of time kind of rechecking ourselves, making sure that we weren't getting caught up in deal fever, and that we still were convicted that this was, at the end of the day, not a vanity project and was going to deliver returns for investors. And then secondly, as you well know, because you taught me a lot of these skills, we had to learn how to navigate the process to either initially via hopefully scheme of arrangement, but in the end via takeover offer, bring a business that was publicly listed private. And it took a lot longer than I thought it would, and had more roadblocks along the way than I initially thought. But because we had that conviction, we managed to get through it. And this is something I will say, I wouldn't have, or we wouldn't have been able to navigate that without the guidance and counsel from yourself and the Clifford Chance team. And it's something that I really did lean on a lot as we came to each decision point over and over again, getting advice from people like yourself who'd been there and done that.
It's very kind of you to say. And shout out to Rob Tang, who was so valuable to us during that takeovers panel process. And were there any moments where you thought, I don't know, maybe I shouldn't have done this one?
I think probably in the dark depths of that takeovers panel process, there were a couple of moments where I had to step back and have a whiskey to give myself some courage. Actually, it's another point. Coming back to your questions around the partnership, Chris doesn't just make sure we're not believing our own fantasies about the business, but there were a couple of times, maybe more than a couple, in that Pacific Smiles process where I went, you know what, maybe we should just sell out and walk and take the profit we've gained. Where he would flip and be like, no, there was a reason we've had this conviction. Let me remind you, and it helped to continue to keep going.
Oh, that's so interesting. How valuable to have somebody that you can, is going to be there in those moments.
Yeah, absolutely.
On the flip side to deals that you have done, are there any that you didn't do that you look back on and think, you know what, maybe we should have gone after that one a little harder?
Yeah. It's interesting. One of the sectors that in health that has been an overperformer over the last 3-4 years will have been the aged care sector. And it was one, 3 or 4 years ago, it certainly was in that position. Coming out of COVID, it was almost uninvestable for a period of time there. And Chris and I had a number of conversations saying, you know what, it might be the time now. It might be the time now, and talk to a few businesses. And there was one that we got close to, but in the end, we decided to err on the side of caution when it came to a premium valuation at the time for a business in that sector, and decided to hold fire. But in the end, that business has gone well. But the truth be told, David, we don't spend that much time thinking about the businesses that we could have done, or maybe should have done, that have gone well.
Yeah.
Because private equity is a little bit different from venture capital. It's an aircraft mentality. Each one of your businesses you want to be a success. We have, touch wood, so far never lost capital on a platform investment for investors, and we take that responsibility seriously, and so we would rather miss a good one than invest in a bad one.
Yeah. Okay. Maybe changing tack now and thinking more generally about the Australian private equity industry. There's been a lot of press about exits and the challenge to monetize platforms. How do you feel about the investing landscape generally in Australian private equity, and do you feel that as a healthcare investor there are tailwinds that are particularly beneficial to you?
I genuinely think it's increasingly robust in investing in Australia. I think it's something that underlying investors see too. In the last couple of years, what we've seen is as China has become less and less investable for large institutions in the region looking to deploy capital in private equity, the beneficiaries have been markets in Asia that have been more mature, like Japan, like Korea, and like Australia. Australia has been a market that over a really long period of time, 20 plus years, has demonstrated really strong DPI and having capital come back to investors. As a result, I think we've seen a little bit of a flight to markets like Australia in the last couple of years. What that means that I think is helpful for firms like Genesis that are playing in that lower mid market is as that capital has come in from institutional LPs, that's typically come in the band above where we are from a fund size perspective. So you see more and more firms at that kind of Australian $1 billion level, including our old firm, as well as the really kind of big end of town, like the TPGs and so on, raising smaller funds that also play in that space. And that band is what we see as our exit universe. So we are doing the hard work, finding smaller mid-market businesses, adding value to them, making them institutional grade, and then representing them to market so that firms like that, as well as trade investors and IPOs, can take them forward. So we are feeling really optimistic actually about exit opportunities over the next 2 or 3 years.
And as a pure play healthcare investor, do you expect to see more and more pure play investors in other sectors in the period ahead?
Yeah, I don't think we'll see. I could be wrong, but I don't think we'll see too many more pure play healthcare investors. I think Australia is an interesting market that it is deep enough for specialists, but probably not deep enough for multiple specialists in a particular stream. Having said that, I think you are seeing flirtations with specialty firms outside of tech and healthcare. And I wouldn't be surprised at all if in 5 or 10 years' time there were a group of 5 or 6 of us in our various specialty lanes investing in the country.
And for LPs in private equity firms or of private equity firms, should they be worried about AI or excited about AI?
This is easily the question we got the most in our most recent round of conversation with LPs. I think if you aren't thinking deeply about AI for your portfolio, then you really are at risk of being left behind. And you've articulated it really well. I think depending on the underlying portfolio company, AI can be primarily a risk or primarily an opportunity. It most often is both, but it is usually primarily one or the other. We've been lucky, I think, and we certainly didn't predict AI, but when you look at our portfolio, because it is healthcare services, pharma services, these are the kind of bricks and mortar, hard to disrupt, or everything is disruptible over a long enough timescale, but hard to disrupt in the kind of short to medium term. And so we really do believe our portfolio is more on the opportunity side of things. But even then, if we don't capitalize on that opportunity, then pretty quickly it'll flip to be a threat, as others in our portfolio's sectors do. So we've employed dedicated AI resources at the Genesis level to help our portfolio move along that journey.
And you look for businesses that have a moat, so it might be sort of proprietary information that informs a bespoke AI solution. Is that something that you look for in your investments now?
Every investment that we take to IC has has to have a strategy about AI, whether that is resilient to AI disruption because of a moat, whether that's because there is an opportunity available to it that is more available to it than other participants in the market that we believe we can capitalize on. At the very least, it has to form a part of our diligence.
Yeah. As a parent with one high school age student at the moment, I'm really struggling to give good advice about career direction in the uncertainty of AI. But are there any thoughts you can offer to young professionals moving into private equity and, how they can maximize the opportunities in an AI world?
Yeah, it's a great one. Particularly recently, as you ask Claude to make PowerPoint presentations for you, it's something that's crossed my mind as well, and also with my father hat on. I think any advice that I think anyone gives is only a stab in the dark at this point. But I think a lot of what I said earlier around the mindset versus the hard skills, really leaning into your commercial thinking, your attitude, etc., versus learning hard skills, like how to build a model, etc., that may more easily be disrupted is what I would give for young professionals that are in the early rungs of the ladder in finance.
Interesting. As we know from current macro circumstances, there are a lot of things that are outside of our control that influence the market. But is there anything in particular that keeps you up at night in your role?
The best thing we can do to be resilient to those shocks is ensure that you're building the best businesses you can and get businesses to be exit ready as quickly as you can, because optimal times for exit can come and they can go, and you hope to be ready when they're there. I think if there was something that keeps me up at night more would be more the people and culture elements of running a business. At the end of the day, as Genesis has grown, I think Chris and I have had to make the transition from being players to coaches. And finding scalability in our team and to get the best out of a team, the Genesis team as well as the team within the portfolio, you need to get the cultural settings right, and you need to get people who are enthused to come to work and really add value in their spheres and are constantly learning and progressing in their own skill sets. That's a really difficult thing. So that's probably something that we are very often thinking about.
And finally, what keeps you focused and energized as a leader of Genesis Capital?
You know what? It might sound trite, but I think we are blessed to be investing in the healthcare sector, and the impact that the businesses, the reason that I made the transition into private equity in the first place was that I could see the impact that building businesses through kind of private capital in the healthcare sector could have on the community and Australians at large. And I'm really privileged that the businesses that we've invested in are all doing that in their own way. And it's in those tougher moments where things aren't always going right, it's a really useful thing to be able to look back on and go, I'm really proud of what we've achieved.
Mike, you've been very generous with your time. Thanks for such a candid and thoughtful conversation. I appreciate it very much.
No, David, it's been a pleasure talking to you. Thank you.
Thank you.